Alrighty, and those of you that are waiting until noon, I'm going to throw in the chat the sign-in link for attending today's workshop. And of course, as always, when you attend a Healthy Lifestyles workshop, it's worth 10 points. So make sure to sign in because that is how we award you your Healthy Lifestyle points for attending. We'll give it about a minute more and then we'll get started. For those of you that just barely joined, please visit the chat and I'm going to repost the sign-in link for attending today. This is how you will get awarded your 10 points for being here. Alrighty, well, let's get started. Welcome everyone to today's workshop. We're so excited to have you joining us. This is our second to last workshop for the Bank on Yourself program, and it has been a wonderful program. And thank you to all of those that have participated, whether that's through workshops or listening to our podcasts or completing the Track Your Triggers challenge. We have had so much great feedback and wonderful success with this program, and we hope to continue that throughout this year. Today we have Tracy Wilder with us today with URS, here to talk to us about savings and retirement and answer any questions that you may have along those lines. And I'll turn the time over to Tracy. Thank you so much for being here.
Thank you, and good afternoon to everybody. Very happy to have the opportunity to meet with you today, and appreciate your interest in learning how to better prepare for retirement. Most members at Utah Retirement Systems will have three primary sources of retirement income: a pension, Social Security, and then income generated from individual savings. The only exception to this would be if you're in the Tier 2 program or retirement plan and you elected the 401k option. Of course, you wouldn't have a pension. Today, we're going to focus on individual savings. Hopefully, we're going to motivate you, if you're not already saving, to start saving. And if you are saving, maybe to increase your savings. We're going to teach you some basic investment principles, some important things to understand. And then I'm going to introduce you to a program that URS has that allows you to meet with one of us for what we call an individual retirement planning session. Many of us underestimate our life expectancy. And as a result, we fail to save enough money to last throughout retirement. As you can see from this slide, currently at Utah Retirement Systems, we have over 4,000 members who are between 85 and 89 years of age. We have a little over 1,700 between 90 and 94, about 450 between 95 and 100, and we have 37 members who are over 100 years old who are still receiving URS retirement benefits. Now, a lot of times when you meet with a retirement planning advisor and you're asked to determine a life expectancy, the common answer we receive is 85. And generally, that's may not be a bad life expectancy to go with. But as you can see, there is a likelihood that you can live past 85. And if you do, then it's important that you're prepared financially for that eventuality. Most of our members, even if they put in 30 years of service, if they have little retirement savings between the pension and Social Security, they won't replace 100% of the income they were earning when they retired. Now, maybe that's not your goal. I know that it's generally recommended to have at least 80%, an 80% income replacement percentage. But for those of us, or those of you rather, who have ambitions during retirement, maybe to travel or to live a more comfortable lifestyle than you lived while working, retirement savings can help you to fill that shortfall. And it can help you to replace 100% of your working income or even more. And of course, that's where we would like everybody to be. Now, why should I save? Well, you want to meet your retirement goals. And a lot of us don't think about retirement until we reach an age where it's too late for us to do a lot to meet our goals. So it's important that we develop goals early in life. Decide early what you want from retirement, what kind of income you'll need to meet what you want in retirement, and then develop a plan to meet that goal. And the earlier you get started, the easier it will be for you to meet your goal. For some people, retirement savings is used to pay bills, to maintain their lifestyle. For others who have saved more money, They can use their savings to enrich their retirement experience by traveling or engaging in hobbies or spending more time with family and friends, maybe grandkids who live in other states. Albert Einstein is credited with stating that compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. Consider this example. If you have $5,000 on a credit card and you're paying 10% interest to the credit card company, you're paying $500 in interest to the credit card company every year. And those interest payments don't reduce the principal you owe on the debt. Now consider this example. Let's assume you have $5,000 in a retirement savings plan and you're earning 10% interest. Well, now you're the one receiving $500 a year. This is passive income. You're doing nothing to earn this income other than investing your money wisely. Starting early can really pay off. The biggest source of regret for near retirees is they wish they had started saving earlier. The second biggest source of regret is wishing they had saved more. Now, the big impact from savings depends on your age. If you get started early saving for your retirement, time is your friend. Compound interest and time will allow the money in your savings plan to grow. If you're a little bit older and just starting to save, then it's going to be for you to move the needle. The biggest impact will come from you increasing the amount of your savings to retirement accounts because now you have less time and less time for compound interest to do it, to make its magic. Here's an example that shows the benefit of starting early. The early saver who saves $100 a month from age 25 to age 35, so contributes a total of $12,000, and then never saves again, by age 65 will have a little over $130,000, assuming 7% rate of growth. Now let's look at the late saver. The late saver delays saving 10 years and then starts saving $100 a month and saves $100 a month from age 35 to age 65. The late saver has contributed $36,000 over that 30-year period. When the late saver reaches 65, they have less money in their retirement savings than the early saver, even though the early saver contributed much less to the account. Here's another example of the importance of starting early and the cost of delaying savings. First, the assumption is that the employee makes about $40,000 a year. They receive about 2% annual raises, and they average a 7% rate of return. The first employee is Julie. Julie invests 15% of her salary from ages 25 to 65. So during that period, Julie would have contributed $375,660 to her retirement accounts. When Julie retires at age 65, the balance in her retirement savings account is $1,652,456. That's the benefit of compound interest and time. Now let's look at Sally. Sally decides that she can't start saving at 25. She still got a long time before retirement, and so she decides to wait until 35 to start investing. Now Sally's going to contribute 15% of her salary from 35 to 65. She will have contributed less to the total amount that she saved, Her total saved contribution is about $310,000. But her balance when she retires at age 65 is $921,198. That's a difference of a little over $700,000, all because Sally delayed investing by 10 years. One of the questions we get frequently is, well, how much should I save? A lot of people think that there's a magic number out there, that if they save this amount, this percentage of their pay, that they'll be fine when they retire. But unfortunately, the answer is a little bit more complicated because it depends on your situation. Factors such as age, when you want to retire, your income replacement goal, and your existing account balances all impact how much you need to save. Somebody who's younger can save less than somebody who's older. Somebody who wants to retire younger has to save more than somebody who's willing to work longer. Somebody who's willing to retire with an 80% income replacement percentage won't need as much retirement income as somebody who wants to retire with more income. And then finally, how much they've saved up to that point will do a lot in impacting or determining how much they need to save going forward. So how much should you save? Well, the number one rule is if your employer does a matching contribution to a retirement savings plan, that is the minimum you should be contributing. Now, it's unusual to find an employer within URS that makes a matching contribution to a retirement savings plan. I know Salt Lake County doesn't. But we do have employers out there, and you may end up working for one of those employers in the future that does have a match to a contribution you make. And so that kind of sets the floor at the minimum that you should be saving because, of course, that's free money. And if you're not taking advantage of the match, well, then you're giving up free money. The other thing we encourage you to do is to save as much as you're able. Of course, you need to consider your financial circumstances. Not everybody has the same ability to save. But you have to be honest with yourself about your reasons for not saving. Do you have legitimate reasons not to save? Or is it just an excuse because you don't want to sacrifice lifestyle today? And then once you start saving, you have to discipline yourself to continue saving. Again, if you start early and you stay with it, you'll be rewarded when you retire. And I can tell you in the 7 years I've done this and with the thousands of people I've met with in that time, I don't believe I have ever met with anybody who complained that they saved too much. Now, here's some basic investment principles that you may or may not be familiar with. The first is risk tolerance. So we have to recognize that every one of us is willing to accept different levels of risk. Some of us are more conservative, some of us are moderate, and some of us are aggressive. We have to recognize and invest based on our risk tolerance. And of course, how we invest can impact the rate of return that we get on investment. If we're a more conservative investor, then we may need to save more. If we're a more aggressive investor, we may be able to save less, but we take the risk that the market could drop and we could lose money in the end. Another principle is dollar cost averaging. I have a slide in a minute that talks about that, and we'll go into that in a little bit more detail in a minute. Diversification is also important. I've got a slide that talks about that in more detail. And then finally, rebalancing. Rebalancing just refers to restoring your portfolio to the recommended investment allocations. over time, as certain assets outperform or underperform, our portfolios can get out of balance. We might have too much invested in a particular sector and need to rebalance that so that we keep recommended allocations within our portfolio. So where can you invest? Well, the things that we're going to be talking about now are the things that are unique and available to you as a member of Utah Retirement Systems. So we have 4 individual retirement savings plans available, and then we have several funds, including target date funds for investments. We also offer the Personal Choice Retirement Account, which is administered by Charles Schwab. This is a self-directed brokerage account where you're able to transfer balances from URS to Charles Schwab and then have access to more investment options. There are specific rules and additional fees. You can see, though, you have to have at least a $30,000 minimum account balance to be eligible for the PCRA program. And if you have more questions on that, there is a brochure on our website that you can read. And then, of course, we encourage everybody to take advantage of the investment profile questionnaire that's available on our website. If you log into the website, click on the education tab, you'll see a link that says investment profile questionnaire. It'll only take you 10 or 15 minutes to answer 10 or 11 questions, and it'll help you to determine your risk tolerance, and it will also give you a recommendation on a target date investment that's suitable for you. Now, these are the 8 individual investment options available through Utah Retirement Systems. We have everything from a low-risk income fund to a high-risk small-cap stock fund. We have a balanced fund, which is 60% stock, 40% bond. We have an index fund, which follows the Russell 2000. And then we also have an international fund. Of course, each one of these funds is diversified within its sector. However, it's important to be diversified across the different sectors. And so we don't recommend placing all of your money in just one of these investments. We would recommend that you design a portfolio of investments that meets your risk tolerance and provides you with diversification as different sectors of the economy perform better than others over time. As you can see, as the risks in the portfolio were greater, the average rate of return over the long term is higher. However, you can see that over year to year, there's more volatility as you prepare to accept more risk. And we've certainly seen that in the last couple of years with COVID and then inflation. Prior to COVID, the economy was doing pretty well. The stock market was doing very well. COVID hit. We had a huge decline in the economy and in the financial markets. That decline was short-lived. It rebounded quickly. But about 2 years ago, we saw an increase in inflation, which again has resulted in a pretty severe downturn in the economic markets. It's important as a retirement investor that you remember that you're primarily a long-term investor. And I'll show you some slides that'll help demonstrate that. Now, a lot of people aren't comfortable choosing or designing their own little investment portfolio. And so that's why, I apologize. I thought the next slide I want to show is this target date funds. So we have a full line of target date funds. These are a professionally designed portfolio of investments. They're made up of stocks, real assets, and bonds. The allocation between stocks and bonds depends on the target date fund, which is matched to the year you plan to retire. So the general recommendation for selecting a target date fund is ask yourself when you want to retire and what year it will be. So for example, if I want to retire in 65 or at 65, and that will be at or near the year 2045, then the target date 45 will be the recommended investment for me. It's, as you can see,
study of insects. There's no more diverse group of organisms on this entire planet than bugs.
Can we get somebody
so
to
if you
mute
really
their
want to
mic?
study what diversity is,
Thank you. So the target date fund has a mix of allocation of stocks to bonds appropriate for somebody who is going to retire in the year 2045. Now, this slide shows the importance of diversification. As you can see here, we've shown the 8 different funds offered through URS. And then we have the years 2010 through 2019, as well as the 10-year advantage at the end. At the top is the highest performing in this, we call this a Callan chart. It ranks each investment from highest performing to lowest performing in a given year. So for example, in the year 2010, the small cap fund performed the best, while the income fund had the lowest rate of return. Now compare that to 2011. In 2011, the bond fund had the highest rate of return, while the international fund had the lowest rate of return. What this chart demonstrates is that no fund will be a top performer year after year. In fact, as you look at this chart, you'll notice that no single fund is a top performer 2 years in a row. In 2010, it was the small cap fund. In 2011, it was the bond fund. In 2012, it was a value fund. But see how I'm going across that top line? And you don't see any color appear twice in a row. So this is why you want to have a diversified portfolio of investments. You can see we've shown how the returns in the balance fund have varied over time. Now, I'll bet if we compared that balance fund to maybe some of the other funds, we'd find that overall, the balance fund, you can see it performed better. On the 10-year average, it performed better than the international fund, the bond fund, or the income fund. And a lot of that is due to the fact that the balance fund is a diversified portfolio. It's made up of the large cap growth, large cap value, and the bond fund. So it's sort of a fund that has some built-in diversification. And you can see that the bond fund, compared to some of the funds that had considerably more risk, because remember, the bond fund is only 60% stock and 40% bond. Funds like the small cap or the large cap funds, or even the international fund. Well, the international fund didn't perform as well, but even the large cap funds didn't perform necessarily significantly better than the balanced fund when you consider how much more aggressive and volatile those particular investments can be. Another thing that's important that can work against you are fees. And at Utah Retirement System, we're really proud of the low fees that are charged for using our retirement plans and the investment options. If you look at our newest brochure that's available on the website, you'll see that the average, that URS charges 0.12% to manage the retirement savings plans and investment options. And then, of course, each of the funds have their own fund managers, and they also charge for their services, which is reflected in the investment fee. Right now, URS's average fee is 0.28%. And to put that in perspective, that's $28 on $10,000 of growth. Now, this chart shows how fees can impact your savings depending on the size of the fee. So again, we're using some assumptions: a starting salary of $30,000 a year. Assuming you save for 35 years, you get a 7% rate of return. Inflation averages 3%, and you have a 2% salary increase. You can see that the first person, or the first person after 35 years will have a balance of $353,240. And with a 0.5% fee, $41,000 would have been paid to fees. Now compare that to someone who pays a 1% fee, and look how it impacts the total balance of their account. See how that total account balance is reduced based on the increased fee. And then finally compare to 1.5% and how that reduces the balance of your account and increases the balance of the fee that you paid. So it's important to be conscious of fees. Now, another principle you may recall we talked about just briefly was dollar cost averaging. Dollar cost averaging is this idea that rather than trying to time the markets and only buy when the markets are low, that you invest the same amount of period on the same period, regardless of market price. So you can see we've shown share prices of $3, $5, and $7 on the vertical axis, and then we've got 5 months on the horizontal axis. If we look at an investor who contributes $100 a month, but only pays $20 per share and refuses to buy when the market is higher than that, then at the end of that 5-year period, they have 100 shares and the total value of those shares is $500. But the green line shows the results of an individual who uses dollar cost averaging. So they just invest that $100. When the market's at $5 a share, they get 20 shares. When the market drops and is at $3, they're able to buy 33 shares. And you can see how even when the market's higher at $7 a share and they only buy 14.3 shares, in the end, they have more shares and a higher total value. So this is dollar cost averaging, and it just means set your investment contribution and don't worry about where the market is in terms of whether it's high or low. Now, earlier I was talking about the importance of long-term investing, and this chart shows the performance of the Dow Jones Industrial Average from 1985 through June 30th of 2020. And as you go along this line, you notice that the general trend is always upward, right? If you were to draw a straight line from that point on the far left of 1,292.67 and connect it to even the bottom mark there with COVID-19, you'll notice the trend is upward. And so that reflects that historically and over the long term, the stock market gives you a positive rate of return. Now, there are periods where the economy drops, where stock prices drop. They may be due to recessions, like the Great Recession we saw back in 2009. We noticed there was a drop in the economy when Great Britain left the European Union. And then, of course, the bigger drop we saw with COVID-19. However, those drops should only be concerning to individuals who are short-term investors or people who are within 5 years of retirement. How does a person who is close to retirement address stock market volatility? Well, that's the importance of having a portfolio that has the correct allocation of stocks to bonds. And that's where choosing a target date fund can benefit you. If we go back to that target date fund, you'll notice that an individual who retired in 2020 or who is planning on retiring in 2025, you'll notice that they have far less invested in stocks and far more invested in bonds. Now, bonds generally provide investors with a less volatile rate of return, so safer, more predictable, albeit a lower rate of return. I want to introduce, here's another slide that just shows the performance of the stock market over a short term. This was January 1st to June 30th of 2020. And you recall this is right after some of the lockdowns that occurred over COVID, which hurt the economy. And you'll notice that this is an example of a very short-term drop in the economy. Over this 6-year period, we saw a fairly substantial drop, reflected like a 40% drop in the market. However, the markets recovered fairly quickly. And if we were to continue to extend this chart out, you would see that they continued upwards until I think it was about January of 2020 when inflation became a bit of an issue, and we saw this period we're in now, where we have kind of had a long period of lower stock returns. I want to talk to you about, maybe you've heard this before, but it's called the Rule of 72. And this is an easy way to determine how long it takes for money to double. So you start with the number 72, you divide it by the rate of return you anticipate receiving on an investment. And the answer, I guess they call it the quotient, is the years it takes for your money to double. So let's look at an example. In the first column, the second column, we have an assumed rate of return of 3%. If you take the number 72 and divide it by 3, the answer is 24. That means if you start with $1,000, it'll take 24 years for that money to double, and then another 24 years for that money to double again. So if you start out with $1,000, you get a 3% rate of return. In 48 years, you'll have $4,000. Now look at the next, the third column. This shows a 15% rate of return. And if you divide 72 by 15, the answer is 14. So every 14 years, your $1,000 will double. So at 14 years, you have 2,000, 28 years, you have 4,000, 42, you have 8,000. And after 54 years, you have $16,000. And then last, let's look at 7%. And 7% is the default rate of return we use for long-term investors. Now, you may do better than that, you may do worse than that, but that's sort of considered a safe, assumed rate of return for a long-term investor. And you can see if you divide 72 by 7, the answer is 10.2, but we're just going to use 10. And you can see that after 50 years, the individual who gets a 7% rate of return will have $32,000 saved. Or that $1,000 initial investment will have grown to be $32,000 in 50 years. So that's $31,000 in passive income. This demonstrates the power of compound interest, as well as the importance of investing starting early, saving early so that you can get more compounding periods, as well as the importance of the rate of return on the bottom line. Now, the following here is information or guidance that can be really beneficial to folks who are getting close to retirement. These are some tax smart strategies. Remember that the income or withdrawals from your 401k, your 457, and your traditional IRA is taxable, and it's just counted like normal income. And so the amount of tax you pay depends on the income you withdraw in a given year. Remember, Social Security can be taxable. In fact, I'm going to guess that for most of us, Social Security will be taxable, and we're going to pay federal taxes up to 85% of our Social Security earnings. Consider contributing to a Roth IRA. The earlier you get started there, the more time that money has to grow. And of course, a Roth IRA provides you with tax-free income in retirement. Now, for those of you who don't have a Roth IRA and maybe you have some balances in a tax-deferred account and you'd like to convert that to a Roth IRA, we call those Roth conversions. Now, before you do a Roth conversion, it's always important to consult with a tax advisor because you have to know what your tax brackets look like, and that depends on your household income. It's important to fill up a tax bucket with the Roth conversion. And what do we mean by that? Well, let's say you pay 12% federal tax on all of your earned income up to $90,000. But let's say during that year, you only have income of $70,000. Then you might consider taking a Roth conversion of $20,000 so that you increase your total income to $90,000, but the money from the amount that you convert from the tax deferred plan to the Roth plan, you're only required to pay a 12% tax on. Another thing to consider when doing a Roth conversion is always convert assets that are lowest in value. So let's say you have a portfolio that's made up of several different funds, and certain funds are down further than others. For example, last year, the large cap growth fund was down almost 40%. Well, if you had money invested in the growth fund, now would be a really good time to convert the money invested in the growth fund to a Roth conversion. The idea is that you convert it while it's at a low. That way, when the market rebounds, as it has in the past, all of the growth that you see in that investment is tax-free. When do you convert? Well, remember, you have to be at least 59 and a half before you have access to your tax deferred plans. If you withdraw money before 59 and a half, assuming you're eligible, you can be responsible for having to pay possibly a penalty tax if you don't convert the entire amount. And then remember, a couple of years ago, the IRS eliminated the ability to undo a conversion. Some people would do a conversion afterwards, think, just, I wish I hadn't done that, and they would try to undo it. That's no longer available. So again, fill up that low percent tax bucket, right? In the year 2022, the taxable income for a single individual, to stay in that 12% tax bracket, you had to have adjusted taxable income of $41,775 or less. If you're married filing joint, you had to have adjustable income or taxable income less than $83,550. This is where your tax advisor can help you. Why do you want to do it then? As well, like I explained before, you want to do those conversions and pay as little in taxes as possible. And so it's the advantage of doing that conversion when you're in the 12% tax bracket is you've locked in that 12% tax on the money converted. Also remember that if you have money in a Roth IRA, it's not subject to required minimum distributions. Now, this slide shows required minimum distributions at 72, but that recently changed. And depending on when you were born, your required minimum distributions now are anywhere from 72 to 75. And of course, if you have your money with URS when you get to that age, we'll help you with your required minimum distributions. Remember, the benefit of the Roth conversion is that the money in a Roth IRA grows tax-free. So when you take that money out in retirement, you don't have to report it to the state or the federal government. And also it lowers your required minimum distributions because, of course, you're only required to take the RMDs from your non-Roth retirement accounts. Another benefit, a tax benefit that many individuals aren't aware of is the taxers or the savers tax credit. This allows individuals who save for retirement to receive a tax credit of up to 50% on the first $2,000 that they saved. It's a tax credit applied to federal taxes, and it's based on your adjusted gross income. So you can see that, and I believe these numbers were based on 2020, but you can see that if if you were married filing jointly and had AGI income of up to $39,000, you would receive a 50% credit on the first $2,000 that you save for retirement. And then you can see as you go across there, you can see how your filing or your filing status impacts the brackets, and also how the credit is reduced as your income increases. Now, remember, a tax credit is actually a dollar for dollar credit on taxes that you owe. So if, let's say, you owe $1,000 in taxes, but you're able to take a 50% tax credit on $2,000 saved, you would eliminate the full $1,000 of federal tax that you owed. Now let's take a look at a little example. So we've got Sue and Bob. Their tax filing status is married filing jointly. They have gross income of $62,000. Now, Sue is contributing $2,000 to a 401k, and Bob is contributing $2,000 to a traditional IRA. Those contributions are subtracted from their gross income to determine their adjusted gross income. So Sue and Bob have an AGI, or adjusted gross income, of $58,000. Now, if we go back to the previous slide, you'll notice that if your AGI is between 42.5 and 65,000, and you file married filing jointly, you're entitled to a 10% tax credit. So both Sue and Bob are entitled to a 10% tax credit. Sue is entitled to 10% of the $2,000, which is $200, and Bob is entitled to 10% of the 2,000 he contributed, which is $200. So both Sue and Bob are entitled to, or combined, they're entitled to a total tax credit of $400. And again, that's a dollar for dollar credit on taxes owed. And if you've already overpaid taxes, that's $400 that the federal government will pay back to you. Now, not everything is about income, right? I mean, some people make a lot of money and haven't learned how to be happy with the money that they spend. And then some people make less money, but are content with the amount that they make. So we're picking, I apologize if we offend anybody, but we're picking on school employees. So we have one individual who's a school superintendent making $200,000 a year, and then a school custodian making $45,000 a year. each is contributing. The employer is contributing to the 401k. The school superintendent, though, doesn't save towards retirement. And every time they get a pay raise, they spend all of the money that they make. Now, that's not unique to school superintendents. That's pretty common among all of us. We call it spending creep or lifestyle creep. It's the tendency that we have to slowly increase our quality of life as we make more money. Now we look at the school custodian who's saving 10%, making substantially less. But with each pay raise, the school custodian increases their retirement savings and they pay down debt. So they're resisting that lifestyle creep. The school custodian has learned to live modestly and is content or happy with their lifestyle. So, as important as saving is, being happy or living within your means is important. And so each of us need to avoid that lifestyle creep, and we need to take advantage as we get raises or increases in pay from our employer. We need to use that money to reward our future selves by increasing our retirement savings and paying down debt. Now, I told you I'd introduce you to a popular service available through Utah Retirement Systems. It's called a one-on-one retirement planning session or individual retirement planning session. This allows you to meet with one of our retirement advisors for 1 hour. And we focus on just you. We'll run projections for your estimated pension benefit, your retire or income from Social Security, and potential income from retirement savings. When you come to this meeting, we're going to ask you to be prepared to tell us when you want to retire and what your retirement income replacement goal is. And then we'll help you to create a plan that will help you to meet your goal. And the sooner you do this, the better, because if you get started early and you realize you're not saving a lot, you can increase your savings and see greater impact over time. Whereas if you come to us at 60 and you say, well, I want to retire at 65 and replace all of my income, it may require you to contribute more than you're able to retirement savings. It may just not be possible to meet that goal. We encourage everybody to meet with us. We have the tendency is for members who are within 10 years of retirement to meet with us. That just seems kind of when people get serious thinking about retirement, but we would love to see more and more younger members. Now, for those of you who are just getting started out, you're in the tier 2 system, you still have 1 year until you have to choose between the hybrid pension benefit or the 401k option. We can help you with that election during these individual retirement planning sessions as well. So how do you sign up for these? Well, you have to log into your account at urs.org. You're going to click on the education tab, and then on the education tab, you'll see a link to individual retirement planning sessions. Click on that link and it will show you our schedule, our posted schedule for the next 30 days. Now, a lot of times, all of our appointments will be full, and that just shows you how popular this program is. But don't be frustrated. Sometimes you have to check in every day to find an open appointment, but we're adding appointments every day. We offer these appointments virtually and in person. And we're finding that certainly the majority of people prefer the virtual appointments because it allows you to work from home. If you're working from home to meet with us, you don't have to go out, like into the cold or like on a day like yesterday where you couldn't go out. You can sit at home. You can meet with one of us over a virtual meeting connection like we're doing this presentation, and we can help you plan your how to meet your retirement goals. So that's everything I have for you. I don't know if anybody has any questions. I'm happy to take those now.
We definitely have a few in the chat.
Okay.
Thank you so much, Tracy, for your wonderful and informative presentation. I know I've learned a lot, and as an individual just starting out my retirement saving journey, super helpful. So thank you so much.
Yeah, you're welcome. Thank you.
We have a few questions. The first one is already been answered, but we can definitely reiterate it. Can URS give SLCO employees investment advice, such as where to place our money?
Within the URS savings plans options, we can give you advice on during those individual sessions. We can recommend a tax deferred plan or an after tax plan, or maybe both. And we can also give you advice on how to invest within our plans. We can't give you advice on, investments offered at Fidelity or Charles Schwab or Vanguard or somewhere else.
Perfect. Next question. Do target date funds change their investment mix as time goes on?
Yeah, thanks for asking that question. Absolutely. So while you're young, most of your investments will be allocated in stocks with very little in bonds. But as you grow older and as you get closer to retirement, that allocation automatically adjusts, where we slowly adjust the allocation so that more of the investment is held in bonds over time.
Perfect.
Yeah, and that'll happen really gradually over. Let me go back. I'll show you this chart. Sorry, I was just. If you look here, you'll notice over from 2060 to the target date retired fund, you'll notice just how gradually the allocation mix between stocks and bonds changes. So it's a very gradual process.
And it seems like it's a long-term game.
Yep. As you can see in this, it's a what is that? That's a 55-year period between the 2060 and the target date retired.
Our next question is, how often should we check our investment portfolio?
Good question. Well, generally, I would recommend at least once a year, right? The analogy I often use when I meet with members in a one-on-one session is that your path to retirement is similar to finding your way using a compass. When you're a long ways away from your destination using a compass, it's important that you check in frequently. Otherwise, you can get off track real quick and then miss your ultimate destination or your retirement goal. So if you check in frequently, make sure that you're still on track to meet your goal. Now, as far as meeting with us, we would recommend, if you're younger, meeting with us maybe every 4 to 5 years. As you get older, maybe shortening the period to, maybe every 3 years.
That's a really good analogy that you put that to. It totally makes sense that we would need to check in frequently, especially, as our destinations and our timelines change. So thank you.
Yeah.
We have a question, and I believe this was answered as well, but it says, why doesn't URS have a Roth IRA?
We do.
Yeah. Perfect. Selena,
And
if you
just
had
sorry
any
to interrupt.
specific, yeah, go ahead.
One other thing, we hope to be offering a Roth 401k in the future. The Roth,
Awesome.
yeah, that will have much higher contribution limits than the Roth IRA.
Cool. That's exciting.
Yeah, that'll be awesome.
Next question. Can you convert to a Roth up to April 15th for the previous year, or do you have to do it in the tax year?
You have to do it in the tax year. A conversion, now understand, a conversion doesn't count as a contribution. So that rule of being able to contribute to a Roth IRA till April 15th or to the tax day only applies to contribution. A conversion isn't considered a contribution. In fact, I believe currently you can convert up to almost $100,000 a year, which is significantly more than the annual contribution limit, which is $6,500 to $7,500, depending on your age.
Yeah, definitely a significant amount more.
Yeah. And so when you do the conversion, the amount you convert from the tax deferred plan will be treated as income in the year that you perform the conversion.
Okay, gotcha. Next question, should I delay investing until the downturn in the market is over the last 2 years? I'm sorry, does that make sense?
Yeah, I understand what they're
Okay.
saying. Absolutely not. Now is the best time to be contributing. Another analogy, you go to your favorite store, everything's on sale. Are you going to say, nah, I'm not going to buy that. I'm going to wait until prices get back up where they are? Or are you going to go out and you're going to take advantage of that sale and you're going to buy all of the things that you wanted to buy, but you couldn't afford? Well, that's what it's like investing when the market is down. Everything is on sale right now. This knowledgeable investors are throwing, especially long-term investors, are throwing money into the market now.
That also is a really good analogy, and I'm giggling to myself because that when you make those, it makes so much more sense. Because that, in real life,
You can
right?
relate to
So,
it, right?
yeah, definitely, it's relatable for sure. Our next question is, can you explain what happened last July when Tier 1 average salary switched to 5 years instead of highest 3 years? And is there something about not making more than 10% each year?
All right.
There's
Yeah.
a couple of questions in this, so we can break it down with that
Yeah.
first.
So that's a pension question, and I don't mind answering that. So first off, in the Tier 1 non-contributory system, it's still the average of your high 3 years. It's never been the average of your high 5 years. So that isn't a change, and that hasn't happened. Now, originally, going back several decades, we had a contributory system. And some members have chosen to stay in that contributory system. All members were given an option several decades ago to convert from the contributory to the non-contributory system, which they should have done. But some didn't. And in the Tier 1 contributory system, they use the average of your high 5 years. And that's always been the case there. So there's been no change in how the average salary is calculated. Now, the second part of that question deals with what's called the 10% rule. And that's not something we've had to deal with too much in the past, but in the last couple of years, we've seen pretty good increases in salaries that people earn. Sometimes it's because, their employer has gone out and done market surveys and found out that they're significantly underpaying individuals, and so they've had to increase their salary. In other cases, it's just been, just occurred naturally. But what the 10% rule states is that when the pension department calculates the average of your 3 high year salary, they have to they won't allow an increase in salary from year to year greater than 10% for purposes of calculating the pension. So you can earn as much as you can earn, but the earnings from 1 year to the next will be capped at 10%. I have another presentation on this. Maybe that's something, we do in the future. But basically the rule is that when they look at your average 3 years, if you're in the Tier 1 non-contributory system, they're going to look back 4 years. They're going to compare your fourth year to your third year to determine that there's not an increase greater than 10%. If the increase is greater than 10%, then they're going to cap that 3% or that third year at 3%. Now, The cap on the 3% or the third year doesn't apply to the second year. So they treat each earning year individually. I don't know if that answers that question. It's kind of complicated to do without slides. Oh, and this is another thing that just occurred to me. The question about the average of the high 3, the average of the high 5, that also changed when they introduced the Tier 2 retirement system, which was in July of 2011. Under the Tier 2 system, the pension benefit required 35 years of service, and the average salary is 5 years. And as far as why was that done, that's the legislature who decided that. So I don't know the answer.
And then our last question that we'll end on today is just a follow-up from when will the Roth 401k be coming out? Do you know?
I don't know exactly. It could be a couple of years in the future. What's going on right now at URS is we're going through we're completely overhauling our systems, the software, the way that employers and employees interact with URS. The idea is that once that overhaul is completed, they may be able to start offering that Roth 401k.
That's a big project on your guys' end.
Yeah, it's I think it started about 5 years ago. I mean, they told us it would be about a 7-year process.
Wow. That's crazy.
Yeah. But it's going to be so much better,
Yeah.
right?
Oh, agreed. For sure.
Going to be a good
That's a
change.
good change. And then is there a contact that individuals can reach out to you about, or would you rather them go through the coaching way to schedule or get a hold of you?
So, if you have general questions about their pension or their retirement savings plans or investments, you can call our customer service department. We do have a retirement planning advisor line where we can give basic, advice, but even the amount of advice we can give there is limited just because of time. And also before we can give a person any type of advice, we have to meet with them to determine their risk tolerance and when they plan to retire. So the best thing to do is that if you're looking for thorough financial advice, you need to schedule an individual retirement planning session. And the only way to do that is online.
Perfect. And we actually have that link posted on our Healthy Lifestyles website underneath Bank on Yourself for those participants that are interested. We've got that contact information for URS to get a scheduling appointment as well as MACU. So Lisa, if you're interested, you can email me and I can get that information to you, or you can visit our website, but it is there for everyone to use. Tracy, thank you so much for your time and your knowledge today and sharing all of these good things regarding saving and retirement. I really appreciate your time. And we've got a ton of different thank yous coming in through the chat as well. We really appreciate it.
Awesome. Great. Hey, can I ask you how many attendees today?
Yeah, of course. We had 47.
Awesome. Thank you. We just tracked that internally.
Yeah, definitely. Thank you so
thank
much
you.
again, Tracy. Have the best day ever, and we'll chat with you soon.
Okay, bye-bye.
With Healthy Lifestyles, the link is in the chat, so please make sure to sign in, and I will stay on for a moment to answer any questions.